There are no fewer than 5 legal documents that the typical American homeowner aged 65 and above is currently overlooking. Documents that could halt, reduce, or permanently lock in the property tax amount they shell out each and every year. 5 documents, and before I move even one sentence ahead, I have to address something critical, because this is the most widespread misconception surrounding property and tax relief programs, and it is the exact reason most qualifying seniors never submit a single application. People presume that a video like this only targets one type of homeowner. Some believe it is exclusively for low-income retirees who are financially struggling. So if they own a comfortable, fully paid-off home, they stop listening. Others assume it only applies to very wealthy individuals with large estates. So if they rely primarily on Social Security, they stop paying attention. Both assumptions are completely off base. And it does not end there. Some of you are sitting here thinking, my home is already paid off, so property taxes are not really a concern. They absolutely are. It is the single largest recurring expense you will ever face on a property you already fully own. The county does not care that you no longer carry a mortgage. The bill arrives regardless. And some of you are currently renting and thinking none of this applies to your situation. It does county in Gramaka, because your landlord is absorbing that tax expense and passing it straight through to you in your monthly rent payment. When that tax bill decreases, your rent stops escalating the way it has been. So this entire breakdown is meant for every single one of you. Whether your home is valued at $90,000 in a small rural community or $400,000 in a county that just completed a reassessment, there is genuine money sitting on this list with your name attached to it. For certain documents on this list, the greatest benefit falls to lower-income retirees. For others, the biggest advantage belongs to homeowners sitting on a fully paid-off house that has tripled in value. I will clarify on every single item exactly which group stands to benefit the most, so no one watching can walk away saying, this does not apply to me. Because the honest reality is that homeowners across every income bracket are quietly overpaying their property tax bills, just in very different ways. The reason almost no one ever tells you about these documents is painfully straightforward. Your county tax assessor's office is financially supported by the taxes that assessor brings in. Every dollar of relief they approve is a dollar. Their own office loses access to the following year. So the county does not pick up the phone to tell you they can freeze your taxes. The county does not mail you the senior exemption application on your 65th birthday. Your mortgage servicer does not highlight it on your monthly statement. The real estate agent who helped you purchase your home never brought it up. And the average property tax bill across this country sits at roughly $4,800 annually. For a 65-year-old who remains in their home for another 2 decades, that adds up to nearly $100,000 walking out the door on a bill that for many of you should be a fraction of what you are currently paying, or in some situations, absolutely nothing. Over the next 20 minutes, I am going to guide you through all 5 documents, one by one, in straightforward everyday language. Then I will cover 3 additional strategies at the end, specifically for homeowners with meaningful assets. Because those final 3 can be worth an extraordinary amount of money, and almost no one ever discusses them. Here is the one concept that connects everything. Being legally entitled to a property tax exemption and actually not having to pay that bill are 2 entirely separate things. The law does not automatically refund you. No one at the county mails you a check. You have to know the document exists and you have to submit it. That is the entire purpose of this video. My name is Walter Barron. I am a licensed estate attorney admitted to the State Bar, and for more than 15 years, I have sat across the table from county assessors, probate clerks, and IRS revenue agents on behalf of real homeowners just like you. And I can tell you the single most heartbreaking pattern I witness year after year. It is not people attempting to manipulate the system. It is honest, diligent homeowners in their 60s, 70s, and 80s continuing to pay a property tax bill they never legally owed, year after year after year, simply because no one ever showed them which document to submit. That is the most costly type of mistake imaginable, because it is completely invisible. There is no warning notice. There is no penalty alert. There is just money quietly draining from your account every single year that never had to leave in the first place. So let us correct that right now. 5 documents plus 3 strategic bonus moves. Stay through to the very end, because the final document is the one that silently drains the most money from people's pockets, and it happens to be among the easiest ones to claim. Let us begin with the one nearly every homeowner should already have in place. Document number 1 is the Homestead exemption, KID. I need you to genuinely absorb this because this is the document most homeowners believe they already have on file, when in reality they do not. Every state in the country, with only a small number of exceptions, provides some version of a homestead exemption on your primary place of residence. What it accomplishes is removing a portion of your home's assessed value from the calculation before the county figures out your tax bill. In Florida, that portion is $50,000. In Texas, it is $100,000 applied to the school district portion of your bill. In Illinois, it is $6,000. In Georgia, $2,000. Every state differs, but every state offers something real. Here is where this trips people up. In certain states, the homestead exemption is applied automatically at the time of purchase. In the majority of states, it is not. You must submit a one-page form to the county appraisal office. Typically before April 30th of the year you want it applied. Miss that cutoff and you pay the full bill for that year. File the form once, and in many states it remains active for as long as you own the property. One piece of paper submitted a single time. Hundreds, sometimes thousands, of dollars removed from your bill every year going forward. Now here is who benefits, and the answer is everyone. If you are a lower income homeowner, that $50,000 exemption in Florida or that $100,000 exemption in Texas can reduce your bill by a third or more. And if you are a financially comfortable retiree sitting on a fully paid off home that doubled in value during the pandemic, the homestead exemption also serves as the gateway to virtually every other exemption covered in this video. The county will not allow you to access the senior exemption, the freeze, the deferral, or the circuit breaker unless your homestead is already registered. So if you only take one action after watching this video, contact your county appraisal office tomorrow and ask one simple question. Is the homestead exemption currently on file for my property in my name? If the answer is no, ask which form you need to submit to add it. That is document number 1. And for many of you, it is the entrance to everything else. That was the foundation. The next 4 carry more weight. Document number 2 is the senior or age 65 exemption, and this one stacks directly on top of the homestead. Most states offering a homestead exemption also provide an additional benefit that activates in the year you turn 65. And this is the document the county will almost never proactively send you. It is a completely separate piece of paper. You have to request it by name. The available amount varies considerably, and this is the point where the lower income advantage and the middle class advantage begin to diverge. In Texas, every homeowner aged 65 or older receives an additional $10,000 reduction on the school district portion of their assessed value, stacked on top of the $100,000 homestead reduction. In Florida, the senior exemption can mean another $50,000 on top of the standard $50,000 homestead reduction, effectively doubling the total amount wiped from your taxable value. In New York, the senior exemption can eliminate up to 50% of assessed value for qualifying seniors. In Illinois, an additional $8,000 reduction applies, and every single one of these requires a separate application from the basic homestead filing. Here is the part where financially comfortable retirees stop paying attention, and they absolutely should not. Many states' senior exemptions include an income threshold. New York cites at around $58,000. Illinois is approximately $65,000. If your income exceeds that threshold, you might assume you are disqualified and never bother applying. But more than half the states offering a senior exemption impose no income test whatsoever. Texas, Florida, Georgia, Tennessee, Mississippi, Alabama, and numerous others base the exemption entirely on age. Income is irrelevant. Home value is irrelevant. You reach age 65, you file the form, and you receive the exemption. So if you are 65 or older and you occupy your own home anywhere in this country, your one assignment after watching this video is to contact your county assessor and ask 3 questions. What is the senior exemption application in this county? What are the qualification requirements? And when is the submission deadline? Obtain the form, file it once, and stop overpaying. Now we arrive at the one that genuinely moves the needle. Document number 3 is the Senior Assessment Freeze, and this is without question the single most valuable document on this entire list. Here is what it accomplishes. When you reach age 65 and submit the freeze application, the county locks your home's assessed value at whatever figure it was in the year you applied. From that moment forward, regardless of how dramatically your neighbourhood transforms, regardless of how much your property appreciates, regardless of how steeply values climb across your zip code, your property tax bill is calculated using the frozen figure, not the current market value. Your home can double in value. Your tax obligation stays exactly where it was. Let me walk you through the clearest possible example. In Texas, once you turn 65 and submit the over 65 tax ceiling application, your school district property tax is permanently frozen at the dollar amount you paid in the year you turned 65. Not just the assessed value, but the actual dollar amount of the bill itself. Your home's value can triple. The bill cannot increase. In Illinois, the Senior Assessment Freeze locks in your equalized assessed value, provided your household income remains below a state-determined threshold. In New Jersey, the Senior Freeze refunds every dollar of property tax increase above the amount you paid in your first qualifying year. The mechanics differ by state, but the outcome is identical. Your tax stops growing. And this is precisely where financially stable, middle-class retirees suffer the steepest penalty for not knowing the document exists. Because the freeze delivers maximum value in exactly the type of neighbourhood where a comfortable retiree tends to live. If your home was worth $220,000 when you turned 65, and it is now worth $440,000, and you never filed the freeze, you are paying tax on every dollar of that appreciation. And you will continue paying on it for the remainder of your life. The homeowner directly across the street who submitted the form is paying tax based on the $220,000 figure. Same house, same neighbourhood, same year of construction. Two completely different tax bills. The only distinction is that one of them filed a single form. There is one critical rule regarding the freeze that you must understand. In most states, you must submit it within a specific time frame, typically between January 1st and April 30th of the year you turn 65, or in certain states the following year. Miss that window, and in some states you forfeit the freeze permanently. That is why this document is the one I emphasize most strongly. Contact the county today. Request the Senior Tax Ceiling or Senior Assessment Freeze application by name. Even if you already turned 65 3 years ago, in many states you can still submit the application. The exemption moves forward, not backward. So every year you delay represents another year of excess payments you will never recover. That is the document most homeowners never hear about. The next one is even less visible. Document number 4 is the circuit breaker, and this one is directed squarely at homeowners living on modest or fixed incomes. The name originates from the concept that when your property tax bill climbs beyond a certain percentage of your income, an electrical-style breaker activates and the state refunds the excess amount. Most people have never encountered this term in their lives. Nearly every state maintains some version of it. Here is how it functions in plain everyday language. You file an application with the state, typically as a component of your state income tax return. Even if you owe no state income taxes, you report your total household income. You report the property taxes you paid during that calendar year. If your tax obligation exceeds a defined percentage of your income, somewhere between 3 and 6%, depending on your state, the state issues you a check or applies a credit against your state taxes for the difference. Massachusetts, Maine, Vermont, New York, Michigan, Minnesota, Missouri, Maryland, Wisconsin, and Illinois all operate circuit breaker programs for seniors. The benefit amounts range from a few $100s annually to more than $1,300. And the application is a state-level form rather than a county form, which is a significant part of why almost no one is aware it exists. The county will never inform you about it because the refund does not originate from the county budget. If you live primarily on Social Security and a modest pension, and your property tax bill is consuming any meaningful portion of your monthly budget, there is an excellent chance you qualify. The income thresholds in most states are not restrictive. New York's cites just under $29,000 for the standard credit, with the enhanced credit extending considerably higher. Maryland's threshold approaches $60,000. So this is not designed as a poverty assistance program. This is a program built for working middle-income retirees, and the application is typically a single page tucked into the final section of the state income tax instruction booklet. So if your state appears on that list and your household income falls below approximately $60,000, search for the phrase Circuit Breaker Property Tax Credit alongside your state's name and submit the form. Certain states will provide refunds covering prior years. Others only apply the benefit going forward. Either way, the form costs nothing to file, the application is 1 page long, and the resulting check is completely real. And now, document number 5, the one I promised you at the very beginning. Document number 5 is the property tax deferral. This is the document almost no one discusses openly, because every county and state that makes it available treats it like a closely guarded secret. Here is what it does. If you are a homeowner above a certain age, typically 62 or 65 depending on your state, and you have occupied your home long enough to satisfy the residency requirement, you can submit an application to defer your property tax payments entirely. That means you stop paying property tax, not reduce payments, a complete stop. The state covers your property tax on your behalf, and the accumulated unpaid taxes become a lien against your property, repaid only when you sell, refinance or transfer the home to your heirs. For a homeowner who is property wealthy but cash poor, which accurately describes millions of seniors across this country, this can be genuinely life-changing. You can remain in the home where you raised your family for the rest of your life without writing a single payment to the county. Oregon, California, Washington, Colorado, Texas, Tennessee, Idaho, Illinois, Massachusetts, and several additional states all offer some variation of property tax deferral specifically for senior homeowners. And here is where financially comfortable middle-class retirees should pay particularly close attention, because this program is not exclusively designed for low-income households. In several states, deferral is available with no income restriction whatsoever. The interest rate the state charges on deferred amounts is modest, in many cases between 2 and 6% simple interest, and the lien is positioned behind your existing mortgage in priority order, if the alternative is selling a home you deeply love simply to keep pace with the tax obligation. This document provides the solution. There is one essential rule you must understand. If you currently carry a mortgage, you must first consult your lender, because certain mortgage agreements treat unpaid property taxes as a default trigger. For a fully paid off home, the deferral process is clean and uncomplicated. One application, typically submitted at the county treasurer's office or state revenue department. Annual renewal required. Tax bill disappears. That is document number 5. And it is the one that silently costs people the most money to overlook, because every year you continue paying a tax you could have legally deferred is a year you withdrew money from your retirement savings to hand directly to the county. For some of you, that single document alone is worth more than the other 4 put together. If you have meaningful assets of any kind, the following 3 minutes will deliver more value than the last 20. 3 strategic bonus moves. The first applies to any homeowner who served in the military. The disabled veteran exemption exists in nearly every state, and depending on the severity of your service-connected disability rating, it can eliminate your property tax bill entirely. A 100% service-connected disability rating in Texas, Florida, Virginia, Pennsylvania, and numerous other states translates to 0 property tax for life on your primary residence. Even a partial rating, 30%, 50%, or 70%, frequently produces a proportional reduction that stacks on top of every other exemption covered in this video. The application is typically a single page, accompanied by a copy of your VA disability determination letter. If you served, submit this form. If a parent or spouse served, investigate whether the exemption is transferable. The second bonus move involves the surviving spouse carryover. When a senior homeowner passes away, their senior exemption, their assessment freeze, and in many states their disabled veteran exemption do not automatically transfer to the surviving spouse. They must be refiled for HIMYG usually within 1 year of the death, and the surviving spouse generally must be at least 55 years old, sometimes slightly younger if dependent children are involved. If a spouse passes away and the surviving partner fails to refile, the property tax bill can surge overnight, sometimes by thousands of dollars, hitting the exact household that just lost half its income. Most counties will quietly allow this to happen without ever raising the issue. The form is brief, the deadline is real. Do not allow the county to quietly absorb your spouse's exemption. The third bonus move has nothing to do with the county granting you a discount. This one involves you formally challenging your property assessment. Every property tax bill is constructed on top of the county's appraised value of your home. That value is determined by an assessor who has never set foot inside your property. They rely on neighbourhood comparable sales. They use square footage measurements. They make assumptions based on limited information. And they are wrong with considerable frequency. Every county in this country maintains a formal protest process, typically available within 30 to 60 days following the appraisal notice. You file a one-page protest. You bring 3 comparable sales from your immediate neighbourhood that came in lower than your appraised value. You appear before an appraisal review board for approximately 15 minutes. And in a meaningful percentage of cases, your appraised value is reduced, sometimes by tens of thousands of dollars, which translates to hundreds or thousands of dollars removed from your tax bill that year, and every subsequent year going forward. The protest costs absolutely nothing to file. It does not require legal representation. The county will not advertise its existence. And in most counties, fewer than 5% of homeowners ever file one day, even though something approaching half of all submitted protests results in a reduction. File a protest on your assessment every single year, especially in the year you turn 65. None of what I have described happens automatically. Your county will never call you. Your mortgage company will never flag it. Your tax preparer will never raise the subject. Every single document on this list, every single one, sits waiting on a shelf at the county assessor's office until you walk through the door and request it by name. The seniors who successfully claim these exemptions are not luckier than you, and they are not wealthier. They are simply the ones who knew the right document existed. If you would like a one-page checklist summarizing every document I covered today, along with state-by-state filing deadlines and a phone script for reaching your county assessor, I have made a free copy available at walterbarronlaw.kit.com/property-tax-checklist. The link is waiting for you in the description below. And if you know even one homeowner over the age of 65 who is still paying a full property tax bill, please share this video with them directly. That single act of generosity could save them $4,800 next year and potentially lock in a freeze they never knew was sitting there, waiting on a form they never knew existed. Thank you sincerely for watching.